Okay, folks, I think we can start. Wow, what a crowd. I think we've exceeded all of our expectations as to how many would be here today, which shows how important this presentation is. I think most of you know I'm Dick Morningstar, chairman of the Atlantic Council Global Energy Center, and it's my pleasure to welcome our distinguished guest, BP Group Chief Economist Spencer Dale, for the U.S. launch of the 2018 BP Statistical Review of World Energy. And as you all know, and I guess the reason why you're all here, the BP Statistical Review is widely anticipated each year. It's looked on as the gold standard report for policymakers, industry analysts, stakeholders from both the public and the private sector, and we're really honored to host this launch here. And this is the third year in a row that we've done this, and again, just a huge, fantastic that there are so many here to hear your analysis, Spencer. Spencer will present the major findings from this year's report, and after which we'll discuss how these findings inform our understanding of the changing energy market dynamics. And I don't think I need to say a whole lot more. I don't want to steal any of Spencer's thunder. He'll describe in greater detail how this review distinguishes and makes clearer, maybe, driving forces behind market developments. Spencer Dale has been BP's chief economist since October 2014, and prior to that was the executive director for financial stability at the Bank of England and a member of the Monetary Policy Committee. And I might ask him during the conversation how a green eye shade person like that, how you fit into doing all the work that you're doing right now. Thank you for being here, and I want to thank all of you as well. I think some of the BP people are chuckling about that comment for some reason. We'll hear more later. So with that, I'll turn it over to Spencer. But this is on the record, and I don't have on here my usual follow on Twitter thing. Gray, what do they do to follow it? Say it. Loud voice.
Hashtag BP stats and AC energy.
Okay, and we are on the record again. Okay. Spencer, all yours.
Thank you very much, Ambassador, ladies and gentlemen. Thank you for sparing the time to come. But the reason why I was slightly chuckling was I thought my green eye shadow was a complete secret I had. It was just between me and the mirror. I didn't realise that Dick knew all about it, so I'm now worried what other secrets he knows. Thank you all for sparing the time to come to the US launch of BP's Stats Review. When you launch the Statistical Review, it's a really weird thing to launch, because the main point of launching a Statistical Review is to say, guess what, everybody? The data have now been updated. They're available free of charge from our website. Go download them, and then you can start using them at your own free will. For people of a certain age, you can get a hard copy. For the younger ones amongst us, you can download them into your Excel spreadsheets. When you do, you'll notice that we've been trying to sort of make sure that not only have we been doing this for the last 67 years, but that we're going to carry on doing it for the next 67 years. So we're going to try and make sure that we update the data that we collect and compile to make sure it answers tomorrow's questions as well as yesterday's questions. So in this year's data, you'll see we have brand new data looking at the fuel mix going into the power sector, which I thought was really quite striking, some of those data, and I'll spend a bit more time on that. We've also got a new section called Key Materials for a Changing Energy System. And the point here is when we're thinking about the energy transition, we don't just care about production and reserves of oil and gas and renewable energy and so on, but also for things like cobalt and lithium, which are key materials in the production of electric cars. And so those data are now in the statistical review. And if there are data you think are important and we should be including, reach out to us, because we want to make sure that we carry on being the reference source for the energy industry for the next, as I say, for the next 67 years. So that's it, ladies and gentlemen. Thank you all very much for coming. No, okay. So that's sort of the main point of the launch, is to say those data are now available. But the other wonderful thing about the Stats Review, it just gives us an opportunity at BP, and hopefully you an opportunity, to just step back and just look at what happened last year in the context of these data, and just sort of say, many of us lived through it, but what actually happened when you can step back in the cold light of day and sort of start to eke out some of the issues and features that we saw and the developments that we saw to help us better understand what that may mean going forward. And so that's the other nice thing about the Stats Review. And I guess from a headline perspective, if viewed from the context of the transition to the lower carbon energy system, so in terms of that context we're all trying to do in achieving a transition to a lower carbon world, last year's data, taken in isolation, looked a little disappointing. Gains in energy intensity slowed, coal consumption increased for the first time in 4 years, carbon emissions from energy use, which had grown by little or no amount in the previous 3 years, picked up. And so the obvious question to ask at that point is, what's going on? Has everything gone into reverse? How should I think about last year's data? And I think the way to think about was, and so those of you who were here last year, you'll remember me saying in 2014, 2015 and 2016, some of that exceptional performance we saw there, some of that was driven by underlying structural factors which carried on again and persisted again this year. Very strong growth in renewable energy, some countries doing strong switching away from coal into other energies. But some of that exceptional performance had been driven by short-run, temporary, cyclical factors, which we always knew were going to unwind. And sure enough, some of those factors did unwind last year. And as a result of which, you saw some sort of partial backsliding. But the point here is, don't see 2017 in isolation. See it in the context that it followed 3 exceptional years, which is why I sort of framed this thing today in terms of 2 steps forward, 1 step back. I'm going to use the slide today. So you may want to, if it's hard to see at the back, we may want to bring the lights down. If you can mess around the lights a little bit to make sure that people can see the charts, that would be cool. If anybody is in charge of lights over there, somebody's put a thumb up, so that's useful. So let me start by just looking at some of the big picture highlights of what happened last year. Global energy demand grew by 2.2%. Thank you so much. That's cool. Is that better? Is that pretty good? I will paint the picture as we go along, even if people can't see it. Global energy demand grew by 2.2% last year. For those of you who don't carry around these numbers in your head, the previous year it grew by 1.2%. Average growth over the last 10 years, about 1.7%. So strong growth in global energy demand last year. Much of that unusual growth was concentrated within the developed world, within the OECD. A big part of that was we saw unusually sort of pick up in economic growth last year to sort of above trend rates, particularly in the developed world. So that's a good news story. The world was growing more quickly, and so it needed to grow its energy use as well. In addition to that, much of that growth was concentrated in the industrial sector. So rather in the service sector, it was concentrated in the industrial sector. That matters because that sector is far more energy intensive. And so as a result of which we saw a slowing in the gains in energy intensity, or if you like, in the improvements in energy productivity, the amount of energy you need to produce each unit of output. It continued to improve, it just improved at a less fast rate than before. So a lot of the unusualness in relative to the average was within the developed world, but in a big picture sense, Where was all this energy demand growing? Much of it was growing in the developing world. So 80% of the growth of energy last year happened in the developing world, outside of the OECD, with China accounting for around a third of that growth. So I think for many of you who think about the energy system, where the energy system is likely to evolve over the next 20 years, the thing to have in your head is the growth markets for energy over the next 20 years is almost exclusively within the developing world, and we saw that last year. In terms of China, China's energy demand grew through by over 3% last year. That compares with growth of averaging a little over 1% in the previous 3 years. So strong growth in Chinese energy demand, particularly as some of its key and very energy-intensive sectors bounced back, and that picked up their growth rate. But at the same time, when I look at China, its growth rate of 3% is still significantly lower than its 10-year average, and its pace of energy decline was more than twice the global average. So again, you had this feature of 2 steps forward, 1 step back. Not as good as 2014, 15, and 16, but still significantly good, better in terms of the round of what we've been seeing. And these sort of dance moves, as 2 steps forward, 1 step back, can also be seen in the overall pattern of fuels, which grew to meet this increasing energy demand. So the forward step was reflected in the fact that around 60% of the growth of energy last year came from a combination of natural gas and renewables. So that's the red and the orange lines here. So 60% of the growth in energy coming from clean or cleaner energy in terms of renewables and natural gas. Natural gas provided the single largest contribution to the growth of energy last year, underpinned by really strong growth in China. And I'm going to come to the China story because it's a fascinating story to understand both what happened last year and what it may mean for the future. The other, and that was closely followed by renewable energy, growing very rapidly, punching far above its weight, led by really strong growth in both wind and solar. And again, I think some of the features of what happened in solar energy last year are also really striking, and I'll come back to that. If that's the 2 steps forward, the step back in terms of the fuel mix was in terms of coal, where coal increased last year following 3 successive years of falling, and then the switch around relative to 2016, where you saw this sharp fall of coal consumption in 2016 followed by a rise in 2017 is quite striking. The country accounting for the majority of that growth of coal was India. But also you saw coal consumption in China grow for the first time after falling for 3 consecutive years. So again, there's 2 steps forward and 1 step back. That's a sort of very, very quick summary of the high-level data. My plan now was to look at a few of the energy markets in turn and try and tease out what was going in each of those markets and sort of some of the messages we should be taking from that. Starting first with the oil market. One of the constant themes of the oil market over the last few years has been the strength of growth in oil demand. And that continued last year. Oil demand grew by about 1.7 million barrels a day last year. That follows growth in the previous year of 1.6 million barrels a day. Again, if you don't carry these numbers around in your head, a 10-year average is a little over 1 million barrels a day. So it's growing about 50% stronger than normal growth. If I look at a 5-year moving average of oil demand, the 5-year moving average of oil demand in 2017 was at its highest level since the peak of the commodity supercycle in 2006-07. So some of you may be scratching your heads going, hold on, I keep reading these stories about peak oil demand, the growth of electric cars, improving car efficiency, and Spencer's just told me it's growing at its fastest rate since the peak of the commodity supercycle. All those factors are real and they're happening. One of the messages we should be taking for the last few years is the power of low oil prices to stimulate demand. We can see very clearly that oil demand responds very strongly to oil prices. And if you like, if I plugged in this profile for oil prices that's materialized over the last few years, if I went back in time in 2014, told my model what would happen to oil prices and said, what do I think will happen to oil demand? I'm not particularly surprised. So in some sense, these elasticities are just working tracking like we think, and that's led to this big growth in oil demand. As you can see, for those who can see, in terms of the colours here, nearly all of this growth in oil demand came from oil importers. So countries who are net oil importers of oil, benefiting from the windfall of low oil prices, driving up that demand. Although in terms of the product mix, there's starting to be some signs that the impact from low oil prices may be beginning to wane. For those who can see, it's now in the bottom right-hand corner, so it may be a bit challenging. What we saw is gasoline demand in the dark green bars there, which is most exposed to low prices. That growth slowed last year, so indicating perhaps some of that impact from low prices may be starting to ease off. In contrast, diesel demand, which is a light green bar, that boosted up very sharply last year. Diesel demand far more exposed to growth in the industrial sector. For those who still remember what I said 5 minutes ago, I was saying industrial sector growth was very strong. That is strong growth in the industrial sector pushing up diesel demand. In some sense, the demand side of oil has been a bit dull in terms of the last few years. It's just consistently strong growth in oil demand. The real excitement and unpredictability has been on the supply side. And in particular, last year you saw this significant interaction between the production cuts of OPEC and the other members who cut their production, led by Russia, sometimes known as the Vienna Group. So I'll refer to it as the Vienna Group production cut. It's called Vienna Group because they made this agreement when they were sitting in Vienna. So you had the production cuts of OPEC and other members of the Vienna Group cutting production, at the same time interacting with the growth of US tight oil and responding to prices. And so a key feature of last year was how did these two things play out. And that's what this next chart is designed to show. So the yellow line here shows the production cuts of the Vienna Group. Their announced targeted cuts was to reduce production by about 1.8 million barrels a day of oil. You can see they pretty much hit that 1.8 million barrels pretty quickly. So this was all relative to their base month of October 2016. They pretty much hit that target by December of 2017, and they stayed around that level for the next 6 months, the first half of 2017. Then production cuts fell beyond that. They overshot their production cuts, ending up at about 2.5 million barrels a day in the most recent data. The key factor which was driving that overshooting of production cuts was Venezuela. Venezuela's production, due to the increasing economic and political crisis in Venezuela, Venezuela's production has declined by about 700,000 barrels a day over this period of time, compared to its targeted cuts of only 100,000. So Venezuela leading to this sort of further lurch down in the production cuts in the second half of 2017, going into the spring of this year. On the other hand, whilst this was going on, we saw exceptionally strong growth from US tight oil. So the green line here shows you the growth of US tight oil, including NGLs, natural gas liquids. That grew by almost 2 million barrels a day over the same period. There are some people who say, well, we've been a bit disappointed by US tight oil. It really hasn't picked up like we thought it was going to pick up. It has picked up by 2 million barrels a day over 18 months. It's astonishing growth. The pace of this growth we've seen over the last 18 months is similar to the pace of growth we saw during the first wave of the shale revolution in 2012, 13 and 14, even though this was against a backdrop of much lower oil prices. So one message to take from this year's data is that US tight oil really did respond to that prompt of lower oil prices. If I look at the net of those two things, so I'm just going to take the difference between the two, you can see here that this strong growth of US tight oil progressively ate into the impact of the production cuts. So the production cuts in the blue line here, they started at about 2 million barrels a day at the beginning of 2017, and by the most recent data, it was less than 1 million barrels a day. So that US tight oil mitigating the impact of the production cuts. Even so, despite this impact of the tight oil, this growth of US tight oil, the net impact of this was to dampen very significantly the overall growth of supply last year. That given another year of strong demand growth, meant you had a consistent period during 2017 where every day the consumption of oil was greater than the production of oil, and as a result of which inventories started to decline, which was the whole point and basis of what OPEC were reducing their production for. So you can see here, the chart, the dark green line here, shows you OECD commercial inventories. They started to fall soon after, or around the time of the OPEC announced their production cuts, and fell by about 150 million barrels a day during 2017. And you can see in about March of last year, they pretty much came into line with the 5-year moving average of inventories, which was the measure initially highlighted by OPEC as their definition of normal level of inventories. Now, there's no perfect measure of normal inventories. There's no sort of great science of that. The mismeasure, which was highlighted by OPEC, is obviously distorted. It's distorted because it includes the most recent couple of years where inventories have been exceptionally high. That's why this measure is trending upwards over this period of time. So that's a distorted measure because it's including the data where the most recent years where data has been very high. An alternative is to say, well, let's ignore that data from the most recent years and just look at the average inventory levels for the 5 years or so up until sort of the end of 2014, shown by this purple line here. But the problem with this measure is it just ignores the fact that oil consumption has increased quite materially since 2015, and people typically want to hold greater levels of inventories as oil consumption goes up. This third measure here, my inventory star measure, tries to avoid both of these problems. So what it does, it looks at the level of forward day cover averaged between 2010 and 2014. It then grosses that up for the increase in consumption we've seen more recently. Based on this inventory star measure, it sort of suggests that the level of inventories today may be a little bit above normal levels, but big picture, first order, is coming to line. So I think the second big message to take from the oil market data is OPEC production cuts worked. They achieved their level of production cuts and indeed exceeded it, and as a result of which inventories have come back down to around normal levels, however people want to define precisely normal levels. So the OPEC production cuts worked, and inventories now, today, ahead of the meeting on Friday in OPEC, around normal levels. The other, so as I said, the other feature to take from the data is US tight oil did respond and grew very rapidly, but in the most recent data we're seeing, there are increasing signs that the potential for tight oil to grow very strongly in the near term may be starting to be constrained. Part of that is increasing sort of noises coming out from investors of increasing sort of reluctance to continue to fund continued high levels of investment without getting significant returns. Also increasing bottlenecks within US tight oil, which may constrain the pace of growth in tight oil over the next sort of 6 to 12 months. The other sort of caveat in terms of growth is what's going on in terms of productivity levels within US tight oil. One of the sort of constant one of the defining characteristics of the shale revolution over the last 4 or 5 years has been sort of almost continuous strong gains in productivity in US tight oil. But the most recent data sort of point to a somewhat different picture. So I'm focusing here just on the Permian, productivity just within the Permian, which many of you will know, it counted for around 2/3 of the growth of tight oil production last year. So this is where the action is. And what that said is, following this sort of period of really strong, consistent growth in productivity, the data for sort of the back end of 2016 through 2017 pointed to quite a sharp decline, with only a very sort of small tick up at the end. And so this sort of raises the question, wow, productivity is really falling off. However, it turns out that much of this slowdown in productivity growth reflects a slowing in the pace at which drilled wells were subsequently fracked and completed, rather than any change in the underlying productivity of the well. So essentially, as bottlenecks increased, production processes became more complex, that the rate of completion slowed, and that meant a conventional measure which just looked at initial output per rig pointed to this sharp slowdown. We can control for that by looking at an alternative measure, which instead shows initial output per completed well. So if you look at output at the point where wells are completed, rather than when they're drilled, this points to a very different pattern for productivity, with productivity sort of flattening out during 2017, rather than actually declining, which is the sort of conventional measures which people look at point to. You can refine this measure one step further, if you like, by recognizing that drilled wells have become increasingly, the length of those drilled wells has increased very dramatically over this period of time. So what instead you can do is look at initial output per foot of completed well, trying to sort of reflect the fact that these wells are getting longer and longer. That also sort of points to a flattening out of productivity. If anything, you see a slight decline in that rate of productivity, but nowhere near as much as sort of the conventional initial output per rig would imply. What message should you draw from this chart? I think one is, caveat emptor, beware if you're using a measure like initial output per rig, which is what many people do, that can give you really distorting messages. One, because it can really get messed up by completion rates. Two, a rig today is very different to a rig 2 or 3 years ago. So beware using simple measures like initial output per rig. The second thing is, these measures of productivity don't necessarily, flattening out in productivity doesn't necessarily tell you anything about profitability. So profitability still may be increasing. If drilling costs continue to fall, profitability still may be continuing to increase. Or if a given acreage is being drilled more intensively, profitability for that acreage still may be increasing, even if productivity is flattening off. So there's no direct link between this and profitability. But I think what the data do show, that when you look at these data carefully, it does suggest that sort of one of that characteristic which defined the shale revolution during its first phase of strong, continuous gains in productivity, that thing may be starting to fade in the most recent data. And I think that's what 2017's data tells us about that. Finally, wrapping up the story for the oil market, if we bring these sort of developments into demand and supply together in terms of what they've meant for oil prices, during the first half of 2017, prices drifted lower. They drifted lower. Essentially, those stocks stayed at persistently high levels. People were worrying about that stock overhang. Prices drifted lower. But as the production cuts started to bite and inventories started to fall, prices then started to rise, reaching a high of just over $65 by the end of last year. And as you all know, prices have carried on moving forward higher since then. Where prices will go from now, I've no idea, but my press officer said feel free to actually make some expectations, Spencer, and put some ideas out there. So I don't know where oil prices will go from now. I think sort of two key factors which will affect this. One, the behaviour of OPEC. How will they respond to those production overshoots? And when and how may they start thinking about an exit strategy from those production cuts? And it will also depend on what happens in US tight oil. Will the increasing strains we've seen in both the finance and the increasing bottlenecks, do that just tell us a story about a short-run growing pains, or does this tell us something more persistent? And what will happen to productivity? Will it carry on falling or not? I don't know the answers to any of those. The good news is I know that next year's stats review will have all the answers, so you can come back and look at them then. That's what I'm going to say on oil. If I turn next to natural gas, which believe it or not, was equally intriguing last year, and equally interesting things going on. 2017 was a bumper year for natural gas. We saw growth of both demand and production of natural gas at their highest levels since the immediate aftermath of the financial crisis. On the demand side, the biggest factor contributing to the demand of natural gas was China, shown this blue bar here. Chinese natural gas consumption increased by 15% last year. It accounted for around a third of the global growth, so really strong growth in Chinese gas consumption. And the story underpinning that is really interesting. So the story, or the motivating factor underpinning it, dates back to a set of environmental targets, so air quality, air particulates targets, which were announced in 2013 with a 5-year sort of window to achieve those targets. So in 2013, these sets of targets were announced to be achieved by the end of 2017. Fast forward 4 years to the beginning of 2017, it became increasingly clear that without very strong further action, those targets were going to be missed. Particularly, they were going to be missed in the northeast provinces of China. So this is Beijing, Tianjin, and about 26 other cities. So you may have read about the 2 plus 26 cities. This is what this referred to, about these provinces in northeast China. So essentially, the Environmental Agency introduced a whole series of measures, if you like, both carrots and sticks, to encourage the use of coal outside of the power sector. This has nothing to do with the power sector. It was the use of coal in industry and in households to switch away from coal, which was causing problems with air quality, into either gas or electricity, with the vast majority of those users opting for natural gas. Some of you may have read about this and heard about over 3 million households switching their boilers, which is just, worth pausing. 3 million households changed their boilers in about a 6-month period. But in terms of actual numbers, that was trivially small to the switch you saw in terms of industry. So the big driver here was even bigger in terms of what was happening in industry. And this caused a massive ramp up in gas demand in China last year. And this ramping up of gas demand was compounded because this switching was happening just at the point as the winter heating demand increased. So that further just pushed up massively the demand for natural gas. As a result of which, you saw really severe strains within the Chinese energy system. Retail and wholesale prices in northern China, shown that chart on the left, just spiked up to really high levels. The chart on the right shows that imports of LNG went beyond notional capacity limits. So they were pushing the limit pushing the system right to the limit to how much imports they could do, as they was desperately trying to get more gas imports. There was also widespread rationing of gas, particularly in the industrial sector, as priority was given to households. You can imagine if you run a factory, you're given these incentives to switch away from coal into natural gas, and then a few months later you're told you have to close down your factory for 2 or 3 months because they've got no natural gas. I mean, this is real. This was what was going on in China last year. Some of these strains are just a function of the pace at which this happened and will be ironed out. But I think these strains also reflect some underlying weaknesses in the infrastructure, or gas infrastructure in China. One of those is a distributional issue, and the network of pipelines is incomplete. There are trucks, you saw trucks of having to transport LNG huge distances across the country at an enormous cost. Even more importantly, it's a level of storage capacity in China which you need to take account of seasonal fluctuations is just inadequate. The level of storage capacity in China is roughly around 3% of consumption. In the US or Europe, it's about 20% of consumption. These infrastructure issues will be addressed, and China have announced a whole set of plans that will address these issues, but the pace at which they can be addressed, even in China, means it's going to take them some years to achieve that. And I think so when we're thinking about, well, what does this mean for gas demand going forward? Are we going to keep on seeing this repeated year after year after year? I think these infrastructure problems tell us that's unlikely. I think arithmetically, gas demand this year would also continue to be very strong because a lot of that surge continued into the first quarter of this year. Some of that rationing we saw in Q4 of last year will be eased. So I expect when I stand on this stage in a year's time, gas demand will have been very strong again in China this year. But what I worry about is people will go, look what happened in 27 strong gas demand and 2018. This is telling us something about the future. And I guess what I'm telling you is no, not necessarily, because these infrastructure issues may well mean the pace of that demand growth for a few years will be more subdued until they get sorted out on some of these infrastructure issues. So that was China, which I think is fascinating in terms of gas demand and trying to understand the underpinnings for it. The other significant factor driving the gas market last year was the growth of LNG. Liquefied natural gas, which has the benefit of increasing the accessibility and availability of gas around the world, helping to underpin global demand for natural gas. LNG exports increased by about 10% last year. That's the biggest growth we've seen for 7 or 8 years, with growth in both Australian and US LNG trains coming on stream. On the demand side, about half of the growth of LNG demand last year was China, for the reasons we've just been talking about, as a desperately demand for gas imports, allowing China to increase its imports of gas, with China overtaking Korea to be the world's second largest import market for LNG, second only to Japan. So big stories moving on in terms of LNG. I'm sort of, if I'm allowed to put my sort of economic nerd hat on for just 1 minute, what's really special about LNG is it's going to completely transform, or is completely transforming, the nature of global gas market dynamics. And it's different because it can be mobile and respond to price signals in a way that pipelines can't. So if this side of the room is Europe and this side of the room is Asia, if Asian demand for gas suddenly goes up and prices go up, and I'm Russia with my pipeline going into you in Europe, what do I do in response to that? Nothing. I can't pick up my pipeline and send it to Asia, so this side of the room is completely unaffected by this side of the room. Prices go up here, prices are unaffected here. With LNG, there's a team in BP that all they do each and every day, they just look at their screens, telling them the potential arbitrage opportunity. If there's an energy vessel going to Europe and Asia suddenly got higher prices, telling it to move across, go to Asia instead and getting that higher price. So what would you expect to see in this world as LNG comes through? You would expect the correlation between the two sides of the room to become increasingly correlated over time, because now these LNG vessels act as a glue, pinning them together. You also may expect the volatility in these different markets to start to converge, because if there was a shock to Asia and it was completely segmented, all that shock would be in Asia and nothing would happen in Europe. Now these markets have opened up, some of that shock would be transferred across, and so volatility in the markets would start to become more similar. Guess what? That's exactly, I'm going to pass these ones quickly. There we are. That's exactly what we've seen. So the chart on the left here looks at the correlation between different regional hub prices. So the top one, the red line, is a correlation between European and Asian prices, and that's been pretty high since the first wave of LNG vessels came on stream at the turn of the decade. But what you can see in the most recent couple of years, as US LNG exports have come on stream, increasing correlations between Henry Hub and Asian and European spot prices. So this isn't just some economist's theory, you can actually see it now in the data. Likewise, the chart on the right, this shows you the volatility of gas prices in those three regions, also converging exactly as we would expect to see as these markets are opened up. So clear information, or clear evidence in the most recent data that LNG really is changing global price dynamics in real time relative to what many of us were taught at school in terms of how these markets operated. So fascinating things going on, I think, in LNG, and last year's data just reinforcing that. That's what I wanted to say in terms of gas. Turning next to coal, and if you remember my 2 steps forward, 1 step back, in some sense coal was the sort of point where some of that sort of step back was most pronounced, because after 3 years of falls in coal consumption, we saw a sort of mini revival in both coal consumption and production last year. On the consumption side, shown here on the left, as I said, India accounted for around 3/4 of the growth
in coal last year, as demand both inside and outside the power sector rose. Also, we saw growth in Chinese coal consumption, Chinese coal consumption also picked up last year. And at this point you'd be going, oh, hold on, I thought Spencer just told me about this massive move away from coal into gas in China. Yes, that happened in the industrial sector and the household sector. But in the power sector, power demand rose very significantly in China last year. Renewables accounted for some of that, but hydropower was relatively weak last year, largely just because of relatively low rainfalls. And so essentially coal was just sucked into the power sector as a balancing fuel. So don't think of this as some big structural change in China, reflecting a change of how they're thinking about coal. I just think of this as, if the power demand's going up, something needs to act as a feedstock, and at the margin, that's coal, and that's what we saw going through there. On the production side, we saw increases in coal production both in America here and in China. In America, coal production increased despite coal consumption in America declining, and instead, so what happened there, increasing exports of US coal, and particularly to Asia. So that's what was telling the story there. In China, you also saw an increase in production, and this increase in production was part of the policy designed to reduce excess capacity in coal. So at this point you think, hold on, how does that work? Why, if China is trying to reduce excess capacity, did this lead to an increase in coal production? And the answer is, China has been going through a process of reducing its levels of excess capacity in its coal sector. As an aside, it's doing this very successfully. On the estimates that we calculate, it's reduced its excess capacity by about a half over the last 2 years. So really significant when people think about that issue. When doing that, though, it's faced this need to sort of have a Goldilocks type price strategy. It's needed to set a Goldilocks price. Too hot, too high a price, and that diminishes the incentives for coal mines to merge or close down. In addition, also raises energy prices for the economy as a whole. Too low, and it would threaten the viability of the coal sector, which still accounts for around 60% of China's energy. So it needs to set a price, not too hot, not too cold. And what China did last year to help meet this sort of balancing between the two, it introduced a price band, pretty much at the beginning of last year, of what it wanted prices to be. The green centre bit was its price band of what it wanted. The blue bits sort of were officially labelled as increasing attention. So if it got there, the authorities would become increasingly concerned about it. And the red lines, if you like, are exactly that. They're the Chinese authorities' red lines for how they did not want prices to go any higher. You can see through much of last year, prices were above the red lines, and so they responded that by saying, well, we need to get coal prices down. We're going to get coal prices down by increasing production and easing pressures in the coal market, and that's exactly what they did. So the increase in coal production last year, you shouldn't necessarily see this as a worrying sign. In fact, this is all sort of central to the strategy which they're pursuing quite successfully in reducing excess capacity within their coal sector. Okay, so that's coal. I want to spend a few minutes now on the power sector. I want to spend some time on the power sector because the power sector really matters. So the power sector is the single biggest consumer of energy. It absorbed about 40% of primary energy last year. It's also at the leading edge of the energy transition in terms of the growth of renewables, increasing energy efficiency. So what's happening in the power sector really matters. In terms of the data for last year, power demand grew by about 2.8% last year. That's pretty much in line with its 10-year average. Almost all of that growth, well over 90% of that growth, was driven by the developing world, showing the light green lines. For those of you who can see the chart, or perhaps if you can't see the chart, you must be thinking, that chart, I can't see it very well because it looks like power demand within the developed world hasn't grown for the last 10 years. That's right. It's not that you can't see the chart. That's true. Remarkably, power demand within the developed world, within OECD, has essentially been flat for 10 years. So when people proclaim the world is electrifying, in many sense the world is electrifying, but it's remarkable that power demand across all the major, if I look across the OECD, is essentially been flat for the last 10 years. It's quite a fascinating sort of feature of the data. We can get into that in the Q&A if people would like. On the supply side, that power generation was driven by renewable energy, wind and solar, which accounted for almost half of the growth in power generation last year. In terms of quantities, wind continued in its role as a sort of more mature elder cousin, but it was solar energy which was making all the waves. Solar capacity, shown in this chart on the left here, grew by 100 gigawatts last year. Solar capacity in China on its own grew by about 50 gigawatts. Even if I take account of the load factors, an average load factor on that solar, that's still equivalent just in China alone to something like 7 or 8 conventionally sized nuclear power stations in one country in 1 year in solar energy. Astonishing growth in solar. Power generation from solar increased by 1/3 on its own last year. Enormous growth in solar. A lot of this continues to be underpinned by policy support. But in addition, it's also helped by really significant falls in costs within solar energy, with many solar projects now last year being commissioned at prices which a few years ago would have just been unthinkable. So significant developments within solar. Perhaps the final chart I want to finish with today is, I think, sort of the most striking and worrying chart in the whole of this year's stats review. And it's a chart which shows the shares of the fuel shares going into the global power sector. It's striking because despite all this effort to reduce our reliance on coal, despite this enormous growth in renewables, we have made almost no progress in this fuel mix. The share of coal in the global power system in 2017 was 38%. The share of coal 20 years earlier, in 1998, was 38%. There is no change in the share of coal over the last 20 years. The share of non-fossil fuels, with this amazing rapid growth in renewable energy, was less than it was 20 years ago. Renewable energy has grown, but it hasn't kept pace with the rate at which nuclear and hydro energy has declined. Rarely has a chart of 3 straight lines been so striking. Worrying, because the power sector really matters. It accounts for around 1/3 of carbon emissions. We know from countless studies, if we are going to get on a road to Paris, the sector where we need to make most progress is the power sector. It accounts for most carbon emissions, and it's the place where you can most efficiently start to get the shifts in fuel mixes we want to see. But this is not a case of 2 steps forward, 1 step back. This is a case of standing still, perfectly still, for the last 20 years. And so I think this should be a wake-up call for all of us. A wake-up call for BP and the role it can play in this. A wake-up call for all of us and how we use power. And perhaps most of all, a wake-up call for policymakers around the world to make sure they focus their actions on the place which really matters, which is the power sector. Ambassador, I'm going to stop now to make sure we have time for some questions and answers. So because I think we covered that earlier, if I can go through that. Let me stop there and we can hand over to other things. Thank you very much.
That was great, Spencer. Such a thorough review of what's been happening. We have about 35 minutes left. I'll ask a few questions and then open it up to the audience. I guess I'll start off by asking, I know you're frustrated a little bit being in the United States during the World Cup. Do you want to give any predictions as to what England's chances are?
I will. I'm feeling very confident about England's performance this year. I'm thinking, if you're an English person, this is terrible. Every time you go a World Cup starts, you say, this year I'm not going to get my expectations up. It's the hope that kills you. And then every year, you can't help it. So this year, up to about a week before, nobody thought we had a chance. Now we went off. It was deeply frustrating. I was live on Bloomberg TV the other day when England were playing, and this was like deeply frustrating. I said, come on, let's get off this thing and watch the game. The good news is England won their first game, so now clearly the whole nation thinks we're going to win, and at some point the hope will be dashed again. So.
Just one more human interest question. We talked about going from a central banker to an energy analyst, and I have to say your expansive personality would not indicate necessarily a central banker, but do you have any comments on that?
You'll be surprised about the private lives of central bankers. When I moved across, I knew. I just spent 25 years in central banking. I loved every minute of that. But you only have one life, and it just seemed too short to spend it on one thing. So BP said, you know nothing about energy. Why don't you come across and be our chief economist? And how could you say no to something like that? The idea of just learning about something new was really exciting. And that's why I did it. When I came across and I was thinking about it, I thought, well, I know I will learn about energy markets. And I knew that. And I thought I will learn about geopolitical aspects in a way that you just didn't have to as a central bank, and I've done that. The bit which I didn't think about, which in hindsight was just a bit silly, was you also have to learn about technology as well, because you can't think about the next 25 years without thinking hard about technology. So why would you not want to be in a space dealing with global issues on something which the world needs desperately to carry on growing and prospering, which is at the forefront of technology, geopolitical and economic issues. So I loved every minute of 25 years in central banking, but I haven't regretted for a moment coming across to energy. I'm having a ball. It's really interesting.
Getting back to your analysis, I do agree with you that your last slide was probably the most significant. You know, the year-to-year changes, yeah, there were some changes, but you explained that, and maybe, by sort of random circumstances that more cyclical, that may not necessarily have a whole lot of meaning. But that last graph with the 3 straight lines was pretty striking, and as you said, it really does raise some yellow flags. So let me ask you this. What would it take to change those lines? What do you see in the next, looking out maybe more from an energy outlook standpoint, the kinds of things that can get back on a Paris track and begin to see some real changes in the fuel mix?
So I think some changes will come through, I think, given what we expect to see over the next 20 years. And what's going on in China will have a big impact there. So when you look around the world, you see both countries within the OECD and in China, massive growth of renewable energy, trying to reduce their reliance on coal, and that is likely to lead to those lines starting to bend. But in the energy outlook, we had something called the evolving energy transition, which was our sort of the path we think the energy system is on if policies, technology and preferences continue to evolve in a pace seen in the recent past. So sort of the path we're on absent a shock. In that world, you saw quite a lot of this shifting, but even in that world, the share of coal in 2040 was still, or the coal was still the dominant source of energy going to the power sector in 2040. You have to work hard to do this. That's the worrying sign. The good sign is we know what to do. And it's not that difficult. What we need to do, and the most obvious thing to do here, is introduce a meaningful carbon price. The reason why the power sector matters so much is not just because it's big, it's because it's where fuels compete side by side. And so relatively small changes in relative prices can have big effects. So what economists around the world and energy people have been doing around the world is saying not only what does it do to get to Paris, is what's the least cost, most efficient, economically efficient way of doing that, and it's the power sector, because small changes in relative prices can have big effects. Now at this point you say, yeah, economists, they always say that, but who knows? There's case studies, and there's 2 case studies which have happened in the last couple of years just to prove that. Here, look at what's happened in the US. It's not a carbon price, but the relative price of gas fell relative to coal, and as a result of which you've seen a very significant shift in the mix between coal and gas here in the US over the last few literally 4 or 5 years, where coal has gone from being the single dominant source of energy into the US power market for the last 40, 50, 60 years, to now gas providing more energy than the US, and then coal. Another example, and I'm English, and so I tend not to talk about England when I'm travelling other than football. But the one thing where I think the UK has been interesting in the last couple of years, it introduced a floor on carbon prices and said if the carbon price within the European trading system, of which we're a member, falls below about 20 sterling pounds a tonne, so very roughly perhaps $25 a tonne, if it falls below that price, we're just going to keep it at $25 a tonne. And it introduced that in 2014, 2015. There's now almost no coal left in the UK power sector. It really works. Now remember, $25 a tonne, very roughly, in terms of cost of abatement, you can multiply that by 10 to the cost of abatement of carbon emissions via electric cars. So this is a really cheap way in making a big difference. Even more frustrating that we've made no difference in 20 years. And so one level of this you sort of despair. I say don't despair, just look at this as an opportunity. We can make significant progress. All of us need to play our role here, but we know how to do this. And it shouldn't cost a fortune to be able to do this. And so I think that's what, in some sense, is a wake-up call for all of us to push harder in a sector which we know matters most.
One of the ironies is that companies like BP and other energy companies, in some ways, it seems to me anyway, have taken a lot more progressive approach towards the environment, certainly than our government and Congress have. And although we're getting, there's more and more discussion among even some Republicans, and in one case, former Republicans. There's an article in the New York Times today about retired Senators Lott and Breaux talking about the need for carbon pricing. Can this happen? First, tell us a little bit about BP's approach, but also, is it realistic to think that we can get carbon pricing in a place like the United States after Trump's withdrawal or intended withdrawal from Paris and the like? How do you see the future on this? Will it become a self-fulfilling prophecy or what?
Yes, many people in this room would know better about US politics than I do. BP is very clear here. We are, all of us, trying to solve a dual challenge over the next 30, 40 years. It's important to remember the dual challenge. The world needs more energy, and it needs more energy to fuel that growth in the developing markets around the world, so they can start to enjoy the sort of standard of living that we do. Without more energy, that living growth, those improvements in living standards will just be stunted and stopped. And so the people who bear the cost of not producing enough energy. It's not people here enjoying the benefits that we're doing here in the West. It's the people who are living in very low incomes, not being able to enjoy access to electricity, still using biomass to cook every day and poisoning their family as a result. So you need more energy, but at the same time, we need less carbon. And trying to solve more energy, less carbon, I think is BP's clear. That's what we want to be part of the solution, trying to solve that problem. We will do that in terms of our own operations. We committed to a whole set of targets recently in terms of making sure that our carbon emissions don't grow, that we start to have limits and clear targets in terms of methane emissions, trying to make sure that we produce our gas in an increasingly responsible way. So we want to play our role. But I think that's part of a broader role that we all can play in terms of trying to get at solving this dual challenge of more carbon, more energy, less carbon. In terms of carbon pricing, Bob Dudley has his statistic in his hand, which I haven't got in my head at the moment, but this is not something which is not happening. It's quite surprising that already today there's a very large amount of carbon pricing around the world. We can see it. I think it's inciting that China has brought its 7 trial markets together into one carbon market for China. I think it will be ironic if China teaches the West how to do a market price for carbon. I encourage them to do it. I think that would be a wonderful irony and hopefully would shame some of us into trying to do it here. The European trading system, which had prices at sort of too low a level for too long. There's been a series of reforms there, so a number of experts there expect that carbon price to gradually move up over time. You will know more about the viability of carbon pricing here, but at least it feels to me like, as you were saying, the senators today, there's the Carbon Leadership Council as well, in which BP is a founder member. At least this conversation is happening here, and I encourage you that this conversation happens. And just intuition here about why this matters. We're trying to find a path to Paris. And we need to find a path to Paris by finding the best way of reducing carbon. You can do that intuitively in one of two ways. One is you put a price on carbon, and then you say to producers, investors, entrepreneurs, financial markets, find the best way of reducing carbon, because there's a price incentive to do that. That will be using technologies we didn't even exist, will exist in 10 years' time, and the path will keep on adapting and changing to find that path. That's one way. The alternative is to say to policymakers today, pick the path for the next 25 years. Do it by regulation, but if you do it by regulation, you have to know now what that right path is. You have to say, how much should I do by electric cars? How much should I do by renewable energy? How much by that technology that don't even exist today? As you said, I used to be a policymaker. I had to set interest rates, one variable, 1 month ahead. That was an incredibly difficult thing to do. I'm sure I got it wrong countless times. If you do this via regulation, you're asking policymakers today to pick winners and losers for the next 25 years. Wow, I prefer carbon pricing.
Let me go, last question I'll ask you. Go back to oil for the moment. And you didn't want to get into price prediction. I was hoping that you would have, because I would have called I would have called my broker. Keep pushing me,
because I just got the nod from my press guy. I think it'll be fine. It'll be fine.
But let's make some assumptions.
Okay,
and,
always
and
dangerous thing to do, yes.
And then maybe you can tell us what you think. Let's assume that OPEC and the Russians, the Saudis, do some increase in production. Let's assume as a result of U.S. actions that there's some reduction, not huge, but some reduction in Iranian production, continuing pressure on Venezuela and Libya, and that the U.S. sort of flattens out a little bit because of the factors that you talked about in your analysis. Where do you see pricing under those circumstances, which I think are not maybe the likeliest scenarios?
Yeah, so I think when prices have risen over the last 6-9 months, I think some of that can be related to that adjustment in the oil market we've just been talking about. So the sort of dark cloud of excess stocks has been removed from the market. Excess stock levels around normal levels now. And that adjustment in the market should have partly contributed to that firming in prices. So that's not going to go away. But I think prices have gone beyond what that adjustment would have done, and I think that largely reflects the sort of uncertainty about future supply. And so that uncertainty about future supply relates both to Venezuela, and as we were saying, still producing 1.4 million barrels a day today. So how much of that will come off, how quickly, is a big issue there. The other one, as you mentioned, is Iran. What were the impact of the administration's decision not to renew the waiver on sanctions? How much will that take off of Iran production, and by when? And that uncertainty, I think, on those two things is staying there. And I guess the question is in terms of OPEC, I think there are two sort of decisions or two elements of OPEC's behaviour which we'll all be watching for on Friday. One is, do they say anything about the extent to which their production has overshot? Are they going to do anything to sort of, rather than overachieving on the production cuts, are they going to do anything to bring back the production levels to their target level? So one is what they're going to say about production overshooting, both now and potentially increases in that overshooting going forward if the Venezuela-Iran comes off. And then secondly, what will they do? At the moment, those production cuts are scheduled to last till the end of the year. Do they say anything about extending them to beyond that, or the nature of their exit strategy after that? So I think that's the two things that people will be watching, and is my way of talking for 2 or 3 minutes without answering your question on prices.
Oh, well. Okay, let's open it up to the audience. I see we have a bunch of questions. Please, we only have 20 minutes, but let's start. Bronco, I saw your hand first, Bronco Terzic. And I identified you.
Yes, I'm Bronco Terzic. I'm a non-resident senior fellow here. And the last chart that you had, the one we were talking about, was exclusively electricity production. Is that correct? And I'm very pleased that you mentioned that you didn't give the number, but I believe it's 1.2 billion people in the world that still don't have electricity. They will need new supply. Energy efficiency and conservation won't help them. China and India have extensive nuclear programs. Here in the United States, we're a private enterprise, but in the rest of the world, it is state-subsidized nuclear. Do your studies or your analysis show any growth in state-subsidized nuclear as one way of meeting the future needs?
So nuclear is a sort of interesting story because there's really contrasting trends, exactly as you say. So on the one hand, it's the big established markets for nuclear. So where nuclear really matters, has really mattered in the past, the US, other parts of Europe. In there, my reading of the recent few years is both the economics of nuclear and the politics of nuclear means you're just not seeing much investment come in. I mean, we've seen some high-profile examples of that in the US over the last 6-9 months. Over the next 10, 15 years, many of the existing nuclear plants will reach critical ages and will start to be decommissioned. And I think that's likely to lead to net declines in capacity over the next 10, 15, 20 years in that part of the world. On the other side, the biggest thing on the other side is China. China is growing its nuclear capacity really very significantly. It only brought on 2 nuclear reactors last year, but that's the weakest it's done for several years. It has something like 19 nuclear reactors currently being built at the moment. The way I remember Chinese nuclear program is to sort of, if you want to get a scale of that, it's roughly equivalent to introducing a new nuclear reactor every 3 months for the next 20 years. New nuclear plant every 3 months for the next 20 years. Those two things are sort of balancing out. When in our sort of outlook, we have those two things balancing out, so the share of nuclear sort of remains sort of pretty constant. I think the upside risk to this, the potential for it to grow, is if China is successful in doing this, it will get better and better at building these plants. And so you'll get some building, some knowledge, some gains from doing. If those gains are transferable such that the economics of nuclear start to improve because we just get some learning curve effects, I think there are some parts of the world where the politics of nuclear means even if the economics get better, it won't work. But there are other parts of the world, Africa, the Middle East, which could well be sort of have significant demands for nuclear if the competitiveness is improved. So I think sort of base case, sort of this flattening, the share flattens with sort of two things going in the opposite direction, but the potential upside risk if we do get some learning by doing in China.
Do you have any thoughts on new nuclear technologies? Small modular reactors, other new technologies?
No, I mean, I'm not the right person. I know people who understand this, and in some of the sort of conversations I half in, people are quite excited by sort of the idea of modular, smaller size nuclear things, but I'm not the right person to talk about that.
Doug Hengel from the German Marshall Fund. He needs a microphone. Herbert?
A question on the quality of energy statistics from the developing countries. For example, we all keep using OECD oil inventories as sort of the marker, but OECD counts for less and less. But just across the board, are energy statistics, particularly from China and India, getting better, or are they still a problem?
So there are certain bits of the statistics we just can't see, as you say. So when we're looking at inventories, I showed you a chart of OECD inventories. Interestingly, OPEC defined their target in terms of OECD inventories because we just don't have inventories for key parts of the world. So particularly in China, how much of those inventories, we don't know what their build-up is. We don't know what that build-up is strategic reserves, which are sort of going to stick, and how much of it is sort of more commercial type reserves, which may well move around. And so there are holes there. I think around the world there's always issues with quality of data, and data gets revised. Sometimes you can't directly observe demand in a country, so sometimes you have to do sort of inferred demand. So you look at production and you look at exports, and you think, well, if they produced it and they didn't export it, they must have done something with it at home. You say that's what they did, and then the next year you realise actually they didn't consume it, they actually built up stocks. And so you have to so we revise our data. I think revising data is a good thing. I always worry about a data series which is never revised. That suggests to me that data is mismeasured. We will always get better and better data as we go forward, so you should look for data to be revised. We do our best in terms of BP Stats Review, but to emphasise here is it is not our comparative advantage, not our role to second guess everybody's statistics. There are some statistics that we adjust to make sure we're comparing apples and apples, but other than that, we try and find the best data source we possibly can in terms of published data. And the value that we do is bring it all together to trying to make sure that across time and across countries, that data series for one country is comparable to the other one. But they, like all stats, they come with health warnings and they're measured with noise and measurement error, and that's just the world we live in, I think.
Okay, I saw a hand there, and then Paula Stern afterwards. This gentleman here. You'll have to identify yourself. Sorry.
Oh, I'm not sure it is.
So, Kostas Andriosopoulos, I'm a professor of energy economics at ESCP Europe in London. The key message here, I think, is electrification, and you did mention that, and you are emphasizing the power sector, but what would that electrification have as a knock-on effect, let's say, for the transportation sector, which is very important for the oil business? And we have, we've been listening a lot about electric vehicles, about the increase in the electric vehicle fleet. I have seen a few numbers and some assumptions. Even if half of the fleet was electric vehicles, globally speaking, it seemed that there wouldn't be a big knock-on effect in the oil prices, or the barrels of oil that we would take out from the system. So, what is your view on that, and what is your expectations for the next 67 years, I guess, on that?
Yeah, so in terms of electric vehicles, so the key thing about electric vehicles is they're going to grow enormously rapidly. This is happening. There's about 3 million electric cars on the planet today. That's likely to increase. Exactly how much it's likely to increase to, I don't know. 300, 400, 500 million by 2040. So be clear, this is happening, this is real. Not only is those electric cars likely to grow substantially in number, in the analysis that we have done recently, we think there's a very strong interaction between electric cars and autonomously driven cars. So those electric cars won't only increase in number, they will increase in intensity with which they are used. So the amount of miles driven by electric cars will increase even more rapidly than their role in terms of just the pure numbers. So do I think this is happening? Is it real? Absolutely real. Will that change the way all of us transport ourselves in 10 or 15 years' time in our relationship with cars? Yes. Is it something that BP wants to be part of? Absolutely. If something's growing from 3 to 300 or 400 million, of course I want to be part of it. What impact does it have on oil demand? Almost nothing. Okay, and that's just arithmetic. If that in that world where I had cars going from 3 million to 300 million being driven twice as aggressively or twice as intensely as an internal combustion engine car because of the interaction with autonomy, that reduced oil demand relative to a world where none of that happened by about 3 or 4 million barrels a day of oil. That's by 2040. That in a world where we start with close to 100 million today and it's likely to carry on growing. if you're BP and you say something like this, trust me, 1,000 people could go over those numbers. We said all of these numbers in February. Nobody's criticised them because it is just arithmetic. And I think it's interesting. If you Google stories on oil demand and electric cars a couple of years ago, you read loads of stories saying electric cars will be the death of oil. I think you don't read articles now like that because people have done the same sums that we had. So to be clear, will they happen? Yes, really strongly. Big thing, I'm not denying any of that. I'm just telling you the arithmetic here means that it won't have almost any impact on oil demand. And again, we don't have time to get into it. But even if all of those electric cars were powered purely by renewable energy, had no implications for carbon emissions whatsoever, purely driven by renewable energy, the impact of all those electric cars in terms of reducing carbon emissions would be almost nothing. It does not move the dial. If you are sitting with a policymaker anywhere in the world and they're telling you, I really want to do these electric cars because of the impact they're going to have on carbon emissions, just tell them to stop. It has improvements in urban air quality. That's great for their citizens for tomorrow. But in terms of helping all future generations in terms of carbon emissions, it does almost nothing. Where the action is, we know where the action is, it's in the power sector. So that's where I think we should be focused.
Would you say the same thing about fuel change in trucks, ships, airplanes, which I realize may be further away, but...
Yeah, so we analyse that. So I think, in trucks, I think it's important to distinguish between light trucks and heavy trucks. I expect the electrification of light trucks to happen as quick, if not quicker, than in cars, and we build that into our scenario. For long-distance trucks, that's the electrification commercial scale of long-distance trucks, I think, is some time away. In our outlook, we have quite a significant penetration of LNG into the trucking, into long-distance trucks, and also into marine transportation. So I think for them, just the density, the size of those vehicles in terms of long-distance trucks and marine transportation, heavy marine transportation, that's hard to do by electrification, so you go via. I think the key challenge or the key sort of penetration of the alternative fuel is LNG in that space.
Okay. Paula Stern, who's a board director of the Atlantic Council. And
Thank you. Thank you so much for your presentation. My question is about trade and LNG in particular. Our president has disrupted our trading system as we have kind of known it, and wants to assure that the United States is a winner by having surpluses in trade with different countries. My question to you is, what role can LNG play in the future from the point of view of U.S. trade and as reflecting its production capabilities?
So one of the sort of factoids that came out of 2017 was the US was a net exporter of natural gas for the first time ever. So it's pretty significant. So this has changed. So rather than being, so now a net exporter, it will still import some gas and export others, but in net terms was a net exporter of natural gas for the first time. So quite a significant shift. We expect natural gas exports, we expect LNG exports to increase significantly over the next 10, 15 years from the US. So the US increasingly running, if you like, a trade surplus in gas, being a net exporter of natural gas, going all around the world. So I think this is a significant role. And the importance of this for America is you need those LNG exports to be able to fully benefit from the natural resource you have in terms of natural gas. Without those LNG exports, that gas would have to be consumed at home. If you consume it at home, prices will fall rapidly and much of that gas would get shut in. And so the issue here is the export of LNG around the world. And I think the challenge to US is, although you're very well positioned in terms of having huge amounts of low-cost gas, there's competition out there. In terms of the Asian market, the most natural fierce competitor you will have over the 10, 15 years is Qatar. Qatar is sitting with enormous amounts of gas. Its gas is actually lower cost than yours, and it's an awful lot closer to Asia than you are. In Europe, you have Russia sitting there with low-cost gas with pipelines going into Europe. The cost of that gas, getting that gas into Europe, is significantly cheaper than having to liquefy it, put it in a boat, and going into Europe. And so the good news is US has already turned a corner and has the potential to grow very substantially, but that's a competitive marketplace out there, and it goes back to those correlations I was showing. This is an increasingly competitive marketplace. So whether you end up being able to compete and win, I think that's sort of the question going forward.
You know, on that score, you said during your presentation that the increase in LNG supplies is changing the very nature, and it has already, the very nature of global gas markets. And that how, in those circumstances, without getting into debates about Nord Stream or Turk Stream or those, you know.
No, I realized I was just about into delicate turf
and
there.
low cost Russian gas. How in the future can you finance gas pipelines if there's total unpredictability on price, and it'll become more and more difficult to have long-term contracts with respect to gas supply?
So I'm not. So I think so. The lovely thing about LNG is, I think, increasingly more and more that will be sold in the spot market. And if you look at LNG contracts, quite dramatic shifts in the pattern of those contracts over time, getting smaller contracts, shorter contracts. So that's the sort of pattern we're seeing. For pipelines, the nature of pipelines, because it's a fixed lump, it's a fixed investment, means you will want to have a contract for that gas. In the past, that gas had been indexed to oil, and that's a really peculiar thing. Why are you indexing it to oil? I mean, for most parts of the world, oil and gas don't compete side by side. So it's just a peculiar thing. And whenever you ask people, they say, well, because there was an oil market and people understood the oil market. But, there's a potato chip market and people understand the potato chip market. So you could index it to potato chips. The good thing about a spot market for gas is we will have a deepening spot market for gas. So these contracts now, for long-term gas contracts, can now be indexed quite naturally to the spot price for gas, which I think seems to me a far more natural thing, because I'm selling gas. I don't know what the price is going to be over time. You can guarantee you're going to buy my gas at 10 years, and the price at which you'll buy that gas will be a function of spot prices moving over time, which seems to be a sort of natural way of doing it.
So I take it what you're saying. If it's being indexed to oil historically has created just as much unpredictability as there would be today on spot markets.
And one could argue
it could still do.
Yes, and even more because it's indexed to something which you're not producing. And you're not selling. So it's sort of just introduced another further. So any shifts in relative prices between gas and oil just confuses that even more. As soon as you index it to the spot, once you get deep spot markets for gas, then that makes it easy.
Okay, we've got about two or 3 minutes left. We have a lot of hands. Okay, I'm going to take 3 questions that I see now, and you can answer them all at once. Or not, as you please.
Yes, great.
So I saw your hand first. Sorry, not going to be able to get to you back there. Sorry, Mary.
Thank you for presentation. Fascinating. I'm Counselor for Energy Issues from the Embassy of Azerbaijan and former Director for Energy and Minerals from the ECO. Concerning oil price forecast, you mentioned conventional factors, but what do you think technology, how it will affect the technological advancement, the future oil price shift? And we know that there is much more oil in the Earth's crust than previously predicted. Some say plus 25 trillion barrels, etc. Half of that is recoverable today with the current technology. Tomorrow we will recover from the unimaginable places, permafrost, etc. How it will affect the present shift in the energy transition, as well as how do you refer that China, India, that they are in the far front of the energy revolution power, but as well as that they are the biggest polluter, let's say. Okay, so will be enough to be on track with the Paris Agreement?
Question 1. Okay.
Question 5, I think. But
5 questions. Bill Icord, and then a question over here.
In your February report, you talked about In your February report, you talked about the penetration of renewables and some of the projections on that. Can you reconcile that with your flat lines that you showed today? And
Yeah.
Is it consistent, and what do you see the lines? How do you see the lines moving?
And then we had a question over here.
What do you think will happen with Iran when the sanctions start to take effect?
That'll be a quick answer.
Okay.
Okay.
Let me do it in reverse order so I can try to remember. So Iran's production has increased by about 900,000 barrels since the sanctions were lifted. So that gives you a scale of what we're talking about. I think most people do not expect that to come off that quickly. So the question about is how much of that will come off, how quickly. We don't know. If you did a consensus of market expectations, the consensus of market expectations is around perhaps somewhere between 300,000, 400,000, 500,000 over the first 6 months. That's the sort of number that the market consensus is out there. I'm not sure I know any better than the market consensus. So if you want to think, I'd use the market consensus one. Yes. This is entirely consistent with renewables. What happened was renewable shares growing, and it did really grow. But the other side of that is the nuclear share was coming off, and the hydro share was coming off, and the renewables wasn't coming on quickly enough to compensate for the declining hydro and nuclear. If we go forward with our hydro and nuclear shares sort of stabilising, then you would expect that non-fossil fuel thing to be improving over time. So, but it's just, I think people are well aware of renewables. I think they forget about the other things moving in the opposite direction, and it's just, so one's in your mind, the other one's not, but when you put them two side by side, you realise actually the one that was in my mind was actually bigger than the first one. In terms of oil abundance and technology, my colleagues in the front row sort of sigh deeply because I can speak for about an hour on this topic, and they're going, we're never going to get home. I think the simple answer here, I think when you're looking a long term ahead in terms of oil prices, I think technology which may allow oil to be produced by 50 cents cheaper here, $1 cheaper there, I don't think that's where the issue is. I think the big issue here is how successful oil producing countries around the world are at reforming their economies so they can sustainably produce oil at lower oil prices. So that's not to do with technology, that's changing the structure of the economy. So if you need to focus on one thing, I wouldn't focus on technology, I'd focus on how successful is, for example, Saudi Arabia with Vision 2030 and all the other types of reform programs around the world. I think that's a defining thing. And if I'm allowed just to plug a piece of work for people who aren't interested in this, I wrote a paper on this with an Oxford academic called Bassam Fatou called Peak Oil Demand and Long-Run Oil Prices, available from our website or from the Oxford website. And that sort of takes, that's the 1 minute answer rather than trying the patience of my colleagues to give you the 2 hour answer.
Just a point on Iran before we stop, and the question on Iran. Given what will be resistance from China and India with respect to sanctions, possibly Japan and Korea and other Asian countries, and the fact that the EU, opposed to what we're doing and would not create a total ban immediately like it did in 2012 when there was joint sanctions. I would really be surprised if it ever got beyond a reduction of 300,000 or so barrels a day.
So I think the issue here, and I don't know what the answer is, there's one thing about what those countries you mentioned would like to do,
right,
and the other question is what they can actually do in a world where it's not the sort of the frontline sanctions, it's the financial sanctions that go alongside. It's the insurance, the sanctions on financing and insurance, and so there may be countries around the world who are willing or would like to carry on, but their ability to do that may well be severely constrained by the financial sanctions and things like insurance. And so that's where the bite happens, rather than in terms of the willingness or not to.
I agree with that, but in Asia, particularly in Asia, there are going to be alternative ways of financing through institutions that don't necessarily have U.S. connections, particularly in China. Anyway, we could go on forever on that. I think we're done. But this was really, really terrific, Spencer, and I know that we've kept 97% of our audience, so that's that may be a record here. So I'd also like to thank the audience. Thank you for what was a terrific presentation, and let's give Spencer a good round.
Thank you very much. Thank you.